Hey everyone, welcome back to Corporate Decoder, the place where we break down complex financial filings so you can understand what companies are really up to. And let me tell you, this report is a classic example of a company getting its ducks in a row, almost too much. Today we are diving deep into Cantor Equity Partners V Incorporated's latest Form 10, Q filing for the quarter ending the 30th of September 2025. It's a bit of a peculiar one as it reads more like a blueprint for a future IPO than a report from an already operating business. Stick around because we are going to decode what all this means for the company's journey. And hey, if you love getting straight to the point insights from these filings, be sure to subscribe and join our Discord community linked in the description below. So let's start with the basics. Cantor Equity Partners V Incorporated is essentially a blank check company, also known as a Special Purpose Acquisition Company or SPAC. Its main goal is to merge with or acquire another business, and that is exactly what it's been preparing for. The report details their efforts leading up to what they call an initial public offering or IPO. This is where a private company sells shares to the public for the first time, and that is precisely what Cantor Equity Partners V has been working towards. They've been busy with the administrative and financial groundwork for this big event. Looking at their balance sheet as of the 30th of September 2025, we see a few interesting numbers. The company has deferred offering costs amounting to about $164,309. Think of these as expenses like legal fees and other administrative costs that are directly related to getting ready for their big IPO. They also incurred accrued expenses of $91,634, which are basically bills they owe for services they've received. Interestingly, they have a note payable to a related party for $118,175. This usually means money borrowed from someone connected to the company, like its founders or major stakeholders. This debt was likely used to cover initial operational costs before they could raise funds through their planned IPO. Now, like many companies in their early stages, especially those preparing for an IPO, Cantor Equity Partners V has an accumulated deficit of $70,500. This just means that up to this point, their expenses have been more than their income. This is perfectly normal for a company that has not yet started its core business operations. When we look at their income statement for the 3 months ending the 30th of September 2025, it's pretty straightforward. They reported general and administrative costs of $42,945 and a net loss of the same amount. This confirms that their activity during this period was mainly focused on operational preparations and administrative tasks, not revenue-generating activities. Their net loss per S-share for the same period was a tiny fraction, $0.01. This small number, combined with the overall losses, highlights their early-stage status. They are still in the setup phase, incurring costs to get ready for their primary business activities. Now let's talk about their shares. The company has Class A and Class B ordinary shares. The Class B shares are often held by founders and early investors. In the period leading up to the 30th of September 2025, they had 632500 Class B ordinary shares issued and outstanding. These shares often come with special voting rights or other privileges. Looking back at the end of 2024, their financial position was much simpler. They had total assets of only $306, mainly from deferred offering costs, and total liabilities of about $2188. Their accumulated deficit was much smaller then, at $26,882. This shows a clear progression in their financial activities as they moved closer to their IPO goals. When we examine their cash flow statement for the 9 months ending the 30th of September 2025, it paints a clear picture of a company building rather than operating. They used $118,175 in operating activities, which is largely due to increases in deferred offering costs and accrued expenses. They had financing activities providing $118,175. This indicates they were drawing on funds likely from related parties or initial investments to cover their operational preparation expenses. The core of this report is about their upcoming business combination. This is the point where Cantor Equity Partners V will merge with or acquire another company. They have strict rules to follow, like ensuring the combined entity is worth at least 80% of the assets held in their trust account. This is a crucial step to ensure the SPAC is not just a shell, but is acquiring a substantial business. A big risk for any SPAC is not being able to find and complete a business combination. This report clearly states that if they don't achieve their goal by the 5th of November 2027, they will have to cease operations and return the money from their trust account to the shareholders. This is a critical deadline that hangs over their entire strategy. The big event here is their initial public offering, or IPO, which happened shortly after this reporting period on the 5th of November 2025. They sold 25 million Class A shares at $10 each, bringing in a massive $250 million. They also had a private placement with their sponsor, Cantor EP Holdings, VLLC, selling them over 500,000 shares for another $5.4 million. A key part of a SPAC's IPO is setting up a trust account for Cantor Equity Partners V. This trust account holds a huge $250 million from the IPO and private placement. This money is intended to be used for the business combination and is invested very safely, mostly in US government securities. This is their war chest for acquiring a target business, and it shows the scale of their ambitions. The report also details various related party loans. Before the IPO, they borrowed money under a pre-IPO note from their sponsor, which was repaid upon the IPO. More importantly, the sponsor committed to loan up to $1.75 million to cover expenses after the IPO and before the business combination. This loan, the sponsor loan, is crucial for keeping the lights on during their search and negotiation phase. They also mentioned the possibility of working capital loans if the sponsor loan isn't enough. And to keep things running smoothly, they have an administrative services agreement, paying $10,000 a month to the sponsor for office space and support. It is a small but essential cost to maintain operations. While this report does not detail new risk factors as they are a smaller reporting company, it refers back to risks disclosed in their IPO prospectus. These usually cover things like the difficulty of finding a suitable business to merge with, market volatility, and the potential risks associated with the target company itself. The big one for SPACs is always the deadline to complete a business combination, and the risk of liquidation if that deadline is missed. Looking at the actual numbers, the company had a net loss of around $43,000 for the 3 months ending the 30th of September 2025. This is entirely made up of general and administrative expenses, which is typical for a company in this pre-operation phase. Their cash flow statement shows a clear picture of them actively spending money to prepare for future transactions. The authorized shares are quite a lot. They are authorized to issue 500 million Class A ordinary shares and 50 million Class B ordinary shares. While they had no class of shares issued or outstanding as of the 30th of September 2025, they did have 632,500 Class B shares. This structure is standard for SPACs, with Class B often held by the sponsor and converting to Class A upon combination. They have a business combination marketing agreement with Cantor Fitzgerald, which is an affiliate of their sponsor. They'll pay this firm a whopping $935,000 as a success fee upon completing the business combination. This is a significant cost, but it highlights the importance of having experienced advisors to help them find and close a deal. So, what does this all mean? Cantor Equity Partners V is a company in transition. They have diligently prepared for their IPO and now have substantial capital in their trust account to fund their primary objective, finding and completing a business combination. Their financial statements reflect a company that is investing in its future rather than generating current revenue. Their strategy hinges entirely on successfully merging with a promising business. The clock is ticking on their combination period, and the success of this venture will depend on their ability to identify a valuable target and navigate the complexities of a business combination. It's a high-stakes game of finding the right partner and making the deal happen. Alright, that's our breakdown of Cantor Equity Partners V's latest filing. What's your take on SPACs and their role in the market? Do you think they are a good way to bring new companies to public markets, or do the risks outweigh the benefits? Drop your thoughts in the comments below. If this deep dive was helpful, please hit that like button, it really helps us out, and subscribe for more corporate decoding. And hey, don't forget to check out our Discord community linked in the description for more real-time financial discussions. Thanks for watching, and we will see you next time.